Most people are misreading XRP right now. The biggest story isn't today's price action. It's a structural shift in liquidity that could change how XRP responds to institutional demand, and new research is giving investors a very different way to think about it. In this video, we'll break down Shane Ellis Theory 2.0, examine the latest market microstructure data, explore what it all says about XRP's role in global payments, and separate measurable evidence from market speculation. See, for years, the conversation around XRP has been dominated by lawsuits, exchanges, listings, and price predictions. But beneath those headlines, something more fundamental may be developing. The focus is shifting away from speculation and toward market structure. Specifically, how liquidity behaves when real payment activity begins interacting with limited exchange supply. That's an important distinction, because markets don't move simply because demand increases. They move when demand meets limited availability of liquidity. And according to a recently published research paper, XRP appears to behave differently from many other digital assets during periods of elevated trading activity. Instead of becoming more expensive to trade, the data suggests XRP's liquidity actually improves under certain settlement conditions. If that's accurate, it could help explain one half of the Shane Ellis framework, a theory centered on supply constraints. The other half is understanding where sustained institutional demand might come from. Once those two pieces are viewed together, the discussion becomes much bigger than daily price charts. It becomes a conversation about how modern financial infrastructure may be evolving and where XRP could fit within that transformation. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Ladies and gentlemen, most investors ask the same question over and over again. When will institutions finally start buying XRP? It's an understandable question. After all, institutional adoption has long been viewed as one of the biggest catalysts for the digital asset market. Pension funds, banks, payment companies, asset managers. They arrive in meaningful size. Many people believe prices could follow. But according to the Shane Ellis framework, that isn't the question investors should be asking. The more important question is this: what happens if institutions decide to buy, but there simply isn't enough XRP available on exchanges to meet that demand? That subtle difference changes the entire conversation. It's very important because prices don't move based on how many coins exist. They move based on how many coins are actually available for purchase at a given moment. Imagine walking into a grocery store intending to buy bottled water after a major storm warning. Thousands of people may own bottles of water sitting safely inside their home. But if the store shelves are nearly empty, the only supply that matters is what's immediately available. As demand rises, prices adjust to reflect scarcity. Markets operate in much the same way. The total supply of an asset is important, but the tradable supply is what determines price discovery. According to Shane Ellis Theory, the tradable supply for XRP may be considerably smaller than many participants assume. The original Shane Ellis Theory is built around one central idea: supply shocks. Over time, significant amounts of XRP have moved away from public exchanges. Some tokens sit in long-term investment wallets. Others are held in institutional custody. Some support liquidity operations. Others remain reserved for treasury management or strategic purposes. Whatever the reason, the result is the same. Those coins are no longer sitting inside exchange order books waiting to be purchased. That distinction matters because order books determine how easily buyers and sellers can transact. When order books are deep, large purchases can be absorbed with relative little impact on price. But when liquidity becomes thin, even modest buying pressure can force prices higher as buyers consume available sell orders. Now imagine that instead of a retail trader purchasing a few hundred or a few $1,000s worth of XRP, a multinational payment provider needs tens of millions of dollars, or an ETF, or a financial institution integrating blockchain settlement to its operations. Those purchases don't happen one coin at a time. They arrive in large blocks. If enough supply isn't immediately available, buyers must continue moving up the order book, accepting progressively higher prices to complete their orders. The process is also known as slippage. It's one of the oldest principles in market structure. The thinner the liquidity, the greater the potential price movement. Now, this is what most people miss. Shane Ellis Theory doesn't argue that XRP automatically becomes valuable. It argues that if a meaningful utility-driven demand develops while exchange liquidity remains constrained, price discovery may occur much faster than many investors expect. That's an important distinction. It's a market hypothesis rooted in liquidity mechanics, not a guarantee of future performance. History offers several examples of how supply constraints can dramatically reshape markets. One of the most well-known occurred during the late 1970s, when the Hunt brothers accumulated enormous positions in physical silver and silver futures. As available supply tightened, prices accelerated at an extraordinary pace, climbing from roughly $6 an ounce to nearly $50 before regulatory changes and market pressures eventually reversed the move. Now, no serious analyst would suggest XRP is identical to the silver market. The assets are fundamentally different. The participants are different, and the regulatory environments couldn't be more different. But the underlying lessons remain relevant. When available supply contracts while buying pressures intensifies, markets can reprice far more quickly than traditional valuation models would suggest. Sometimes prices drift higher over months. Other times they leap because liquidity disappears before new sellers emerge. That's precisely the dynamic Shane Ellis Theory attempts to describe. Not certainty, not predictions, but a structural explanation for how rapid repricing could occur if specific market conditions align. And for years, that theory answered one important question. Why could prices move so quickly? But it left another question unanswered. Where would the demand actually come from? Because supply constraints alone don't create price appreciation. They require buyers. They require a catalyst powerful enough to overwhelm existing liquidity. And that's where the conversation begins to change. See, because in April 2026, a research paper examining XRP's market microstructure introduced evidence that many believe explains the missing half of the equation. Not the supply shock, but the demand shock that could potentially trigger it. And what those researchers discovered challenges one of the oldest assumptions in financial markets. Because during periods when most assets become more expensive to trade, XRP appeared to become easier. That single observation may prove to be one of the most important pieces of the entire discussion. And that's where the story gets even more interesting. See, to understand why the observation matters, we first need to look at how markets normally behave. In almost every financial market, periods of heavy buying create more uncertainty for market makers. Orders begin arriving faster, inventory becomes harder to manage, volatility increases, and because of that added risk, bid-ask spreads typically widen. It's a form of protection. Market makers charge a larger spread because they're taking on greater exposure while trying to facilitate trades. You'll see this behavior across stocks, commodities, foreign exchange, and even most cryptocurrencies. As volatility rises, liquidity often becomes more expensive. But according to a research paper published in April 2026 by Public Research, XRP appeared to do something very different. Instead of spreads widening during periods of heavy activity, they actually became tighter. That finding caught the attention of many analysts because it runs directly against what traditional market theory would predict. Paper titled XRP Bridging Corridor, Empirical Microstructure Evidence for Settlement-Driven Spread Compression, analyzed how XRP behaved during periods of elevated trading activity. And the numbers were difficult to ignore. During heavy trading, XRP's bid-ask spread compressed by approximately 12.67%. By comparison, another major digital asset, BNB, experienced spread widening of roughly 3.17% under similar conditions. That's a difference of nearly 15.8 percentage points. In market microstructure, that's significant. It suggests XRP may be operating under a different set of dynamics than many other digital assets. So why would this happen, ladies and gentlemen? The researchers point towards one characteristic that has defined the XRP ledger since its earliest days: settlement speed. Unlike many payment systems that require lengthy confirmation periods, transactions on the XRP ledger typically settle in around 3 to 5 seconds. That may sound like a simple technical advantage, but inside professional trading environments, it's much more than that. Every second a market maker holds inventory carries risk. Prices can move unexpectedly. News can break. Currency markets can shift. The longer capital remains exposed, the greater the uncertainty. Now imagine reducing exposure from minutes or even hours down to just a few seconds. Suddenly, the risk profile changes. Market makers don't need to build as much protection to their pricing because capital isn't tied up for nearly as long. That allows them, at least in theory, to quote tighter spreads while continuing to facilitate transactions. Lower risk, lower trading costs, better liquidity. It's a chain reaction. And according to research, that reaction becomes especially visible during periods of genuine payment activity rather than purely speculative trading. Now, this is where things become especially interesting Because the researchers weren't simply looking at random spikes in trading volume. They were looking for patterns, and one pattern appeared again and again. The strongest spread compression didn't occur randomly throughout the day. No. Instead, it appeared mostly prominently during business hours associated with major on-demand liquidity, ODL, payment corridors, particularly across the Asia-Pacific region. That's an important distinction. If spread compression occurred equally across all hours, it might simply reflect broader market conditions. But seeing it concentrated during periods when payment flows are expected to be most active suggests something potentially more meaningful. It hints that real-world settlement activity, not just speculative trading, it could be influencing market behavior. Write that down. According to the paper, similar patterns weren't observed across networks such as Ethereum, Solana, or BNB. That doesn't mean those ecosystems lack value. Each serves different purposes within the digital asset landscape. Ethereum has established itself as a leading platform for smart contracts. Solana focuses on high throughput and low transaction costs. BNB supports one of the largest exchange ecosystems in crypto. But the researchers argue that XRP's role as a bridge asset for cross-border settlement creates market conditions that differ from assets designed primarily for other use cases. Again, this doesn't prove future price appreciation. I want to be clear about this, ladies and gentlemen. What it suggests is that XRP's market structure may respond differently when transaction volume is driven by payments instead of speculation. That's a subtle distinction, but potentially an important one. Think about the logistics of a global payment network for a second. Every international transfer requires value to move from one jurisdiction to another. Banks, payment providers, financial institutions, liquidity providers. Each participant wants transactions completed quickly, efficiently, at the lowest possible cost. If settlement delays create additional risk, that risk eventually becomes an expense. An expense influences adoption. The cheaper and more predictable a system becomes, the easier it is for businesses to justify using it. That's one reason many analysts continue watching developments around Ripple's payment infrastructure so closely. If lower settlement risks lead to tighter liquidity, and tighter liquidity encourages greater transaction volume, then increased utility could gradually create additional demand for the underlying asset used in the settlement. This is so important, ladies and gentlemen. I spend so much time telling family offices this. Notice the sequence. Utility first, demand second, price comes later. It's very different from the speculative cycles that have defined much of crypto's history. Prices reacting, systems evolving. Short-term noise, long-term structure. Those two ideas can exist simultaneously. Markets may remain volatile from one week to the next, yet beneath the volatility, the financial infrastructure supporting digital assets can continue developing. And that's exactly why so many institutional observers spend less time watching daily candles and more time watching adoption metrics. A useful way to think about this is through history. Roman road network didn't create commerce simply because roads existed. It creates value, real value, from reducing the time, cost, and uncertainty involved in moving people, goods, and information across an enormous empire. As travel became faster and more reliable, trade expanded naturally because the underlying infrastructure made economic activity easier. In a similar way, some analysts view settlement infrastructure as the modern financial equivalent. The asset itself isn't necessarily the destination. It's the part of the network that allows value to move more efficiently between participants. Whether XRP ultimately fulfills that role at a global scale remains to be seen. But that's the framework many researchers are now examining, not just price charts, but the infrastructure beneath them. Because the original Shane Ellis Theory attempted to explain why limited supply could accelerate price movement, this research begins exploring where sustained institutional demand might actually originate from. And once you combine those two ideas, supply constraints on one side, growing utility-driven demand on the other, you begin to understand why some investors refer to this as Shane Ellis Theory 2.0. The conversation is no longer just about shrinking exchange balances. It's about what happens when a financial network begins generating consistent demand for the assets that power it. And outside the research itself, several real-world developments suggest that conversation is no longer confined to theory. Ladies and gentlemen, one of the strongest arguments supporting this broader narrative isn't found inside a research paper. No, it's found in what's actually happening across the ecosystem. Because while much of the crypto market continues debating future adoption, Ripple has continued expanding products and partnerships designed for real-world financial use. One development that drew particular attention was the continued growth of RLUSD, Ripple's US dollar-backed stablecoin. Stablecoins have quietly become one of the fastest growing sectors in digital finance because they combine blockchain settlement with the price stability of traditional currencies. For financial institutions, that matters. Businesses generally don't want uncertainty and unnecessary currency volatility when they're making payroll, settling invoices, or moving liquidity between countries. They don't need that. They want speed, predictability, and regulatory clarity. That's where RUSD begins fitting into Ripple's broader strategy. Rather than replacing XRP, many analysts see the two assets serving complementary roles within the same ecosystem. Stablecoins provide stability. XRP provides liquidity and rapid settlement across different currencies. Whether that vision ultimately plays out remains to be seen, but it's increasingly becoming part of the conversation surrounding institutional blockchain infrastructure. Another milestone came from one of the world's largest financial markets, Japan. Ripple and the SBI Group announced the rollout of RLUSD through SBI VC Trade, following approval from Japan's financial service agency, often referred to as the JFSA. For many observers, this wasn't simply another product launch. It represented something much larger. Japan has long been regarded as one of the world's more mature jurisdictions when it comes to digital asset regulation. Unlike markets where regulatory uncertainty has slowed adoption, Japan is generally focused on building frameworks that allow innovation while maintaining consumer protections. That distinction matters. Institutions typically move cautiously before deploying significant capital or integrating new technologies. They want clarity around legal treatment, compliance obligations, and operational standards. Every additional layer of certainty lowers friction, and lower friction often makes adoption easier. See, according to Ripple's executives, the long-term objective is continued expansion of RLUSD across additional markets and financial institutions. At the same time, another statistic caught analysts' attention. This is important, write this down. See, the XRP ledger surpassed Ethereum as the largest host of RLUSD supply, with more than $1.081 billion issued on the XRP ledger compared with roughly $795 million on Ethereum. Write those two numbers down. On its own, that number doesn't determine XRP's future value, but it does suggest increasing activity occurring directly on the network itself. And for investors focused on infrastructure rather than short-term price movements, those are the kind of metrics worth watching. Now, this is what most people miss. Adoption isn't always dramatic. It rarely arrives with fireworks. Instead, it often looks surprisingly ordinary. Another regulatory approval, another payment corridor, another institutional integration, another jurisdiction providing legal clarity. Individually, each announcement may appear as relatively small, you might think. They are. But collectively, they begin forming a much larger picture. See, history has shown that major financial transformations rarely happen overnight. It's like watching paint dry on the wall, ladies and gentlemen. I tell you this over and over again. It's extremely boring. Test the patience here. That's why you got to have that Gucci conviction, that Gucci clarity I talk about all the time. They unfold one connection at a time until suddenly the new system reaches a point where momentum becomes self-sustaining. That's where experienced investors often distinguish between headlines and structure. Headlines move markets temporarily. Infrastructure changes the markets permanently. And that's exactly why legislation has become such an important part of the XRP conversation. In the United States, one of the most closely watched developments has been the progress of the Clarity Act. For years, regulatory uncertainty has remained one of the largest obstacles facing the digital asset industry. Companies have often struggled to determine which rules apply, which agencies have oversight, and how digital assets should be classified. That uncertainty affects far more than investor confidence. It affects business decisions. Banks hesitate. Institutional investors wait. Developers slow expansion. Capital becomes cautious. The Clarity Act seeks to establish a clearer regulatory framework for digital assets, providing market participants with greater certainty about how different assets may be treated under the U.S. law. Supporters argue that clearer rules could encourage innovation while giving institutions the confidence to participate more actively. Ripple has publicly supported efforts aimed at achieving greater regulatory clarity, including visible advocacy campaigns in Washington, D.C. Lawmakers from both political parties have also expressed support for creating more predictable rules surrounding digital assets. Whether the legislation ultimately passes in its current form remains uncertain. That's an important point. Markets frequently price expectations long before laws become reality. But investors continue watching closely because regulation often determines how quickly institutional adoption can expand. Here's a way to think about it. Imagine trying to build a modern city without clearly defined property rights. Businesses would hesitate to invest. Developers wouldn't know which permits they needed. Banks would struggle to finance projects. Economic activity would continue, but much more slowly than it otherwise could. Clear legal frameworks don't guarantee success. They simply reduce uncertainty. Financial markets work the same way. When rules become more predictable, institutions can make long-term decisions with greater confidence. That's one reason legislation often matters far beyond the great headlines it generates. It's not just about today's market reaction. It's about creating conditions that allow participation to expand over time. Short-term noise, long-term structure. Those words become increasingly relevant as the industry matures. Because while traders often focus on next week's price action, institutions are usually thinking years ahead. And one of the biggest long-term themes emerging across finance extends well beyond cryptocurrency itself. It's the digitization of money, not information, money. And that may prove to be one of the most defining economic transformations of the coming decade. Perhaps the biggest idea in this entire discussion has very little to do with today's price action. It's about where the financial system itself could be heading. For decades, the internet transformed how information moves around the world. Emails replaced letters, streaming replaced DVDs, cloud computing replaced physical servers. Now, many analysts believe blockchain could do something just as significant, not by digitizing information, but by digitizing value. Imagine AI systems paying suppliers automatically, autonomous vehicles purchasing electricity on their own, businesses settling international invoices in seconds instead of days. Every one of those transactions requires value to move securely and efficiently. Whether XRP becomes a major part of the future remains uncertain, but the direction of travel is becoming increasingly clear. The conversation is shifting from cryptocurrency as speculation to blockchain as financial infrastructure. That perspective also helps explain why experienced investors separate short-term volatility from long-term structural change. Markets will always experience corrections. Headlines will create uncertainty. Liquidations will shake confidence. During the periods discussed in the original presentation, Bitcoin experienced a sharp flash decline that triggered hundreds of millions of dollars of liquidation within a very short period of time. Events like that can dominate headlines, but temporary volatility doesn't necessarily erase years of technology and technological progress. Price moves quickly, infrastructure develops slowly, and sometimes those two stories move in completely different directions. Short-term noise, long-term structure. Prices reacting, systems evolving. History reminds us that this isn't unusual. When railroads expanded across the United States during the 19th century, speculation became rampant. Some companies thrived, others disappeared, and investors experienced enormous volatility. But regardless of who won or lost, the railroad network permanently transformed commerce. The infrastructure outlasted the speculation. Many analysts believe blockchain could follow a similar pattern. No one knows which networks will dominate years from now, but settlement technology continues to improve it. Regulatory frameworks continue evolving. Institutional participation continues growing. The foundation is still being built. That's ultimately what Shane Ellis Theory 2.0 is trying to explain, ladies and gentlemen. The original theory focused on supply. The new research focused on demand. One asks what happens when exchange liquidity becomes increasingly scarce. The other explores how real-world payment activity could generate sustained institutional demand over time. If those two forces ever converge, some analysts believe the market could experience some rapid repricing. Of course, that's still a hypothesis, not a certainty. Markets are complex. Competition is real. Regulation continues to evolve. And every investment carries risk. But understanding market structure allows investors to look beyond daily price swings and focus on the bigger picture. If you found this breakdown valuable, be sure to subscribe to the channel for more deep dives into XRP, macroeconomics, institutional adoption, and the forces shaping the future of global finance. As always, this video is for educational purposes only. It should not be considered financial advice. Thank you for watching. I'll see you in the next video. Hope everyone's having a blessed day, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Republic Desk Monthly, all the new members of the membership channel. What I find fascinating about all of this is that the second role I had at the New York Mercantile Exchange, I wore the yellow jacket and I was a reporter. I sat in pits reporting the bids and the asks and the price movements after trades went. So when you talk about slippage and market makers, as everything now is digital, there's almost no more trading floors. That's a big thing. It's very, very important. because the market makers absorb everything. So I find this theory fascinating. This is something that I go over with family offices, families, sovereigns, about what I believe, and this is my opinion, could have an explosive impact on XRP. I go over this a lot more detail when I have the time because of what I saw the mechanics of the floors of exchanges move. The volume here is a lot this. But ladies and gentlemen, if you want to learn how to trade, you want to learn how to invest, come and join the Crypto Public Desk Monthly. Join over 600 active traders and investors who are taking advantage of the deeper macro research and the opportunities that arise from geopolitical chaos, instability, supply disruptions, and the headlines. One good tip in the pit can pay for your entire year's subscription, ladies and gentlemen. We're going to cap it at 1,000 because we can't talk to that many people. It's just impossible. But to me, I want to answer as much as I can because this is a theory that I follow closely because the market mechanics of market makers, floors, that has a big thing to do with overall everything. You know, that's the closest thing that I can find that will influence a disruption. Normally, I spend a lot of my days really looking forward for price disruptions in every financial market, mostly futures. Because once I identify that in futures, in a commodity, I can identify the stocks that are connected to that. But this to me is explosive potential for XRP. What's interesting about it is the time lag between places that I find fascinating. But we're stuck in a holding pattern until the markets, here's a better way to put this. The banks are going to follow exactly what the Fed is saying. They're not saying much anymore. So they're going to be more cautious because banks can't afford to lose money. If they lose money, they lose clients. They lose prestige. When you're a financial mercenary and you got that Gucci conviction, that Gucci clarity, and why I say we're the remora, because we're underneath the apex predator, feasting on people's sushi. This is where the Gucci conviction clarity comes from, understanding what actually drives the market and the abnormalities that come from the market. See, I was told on the Fold Mercantile Exchange, I don't really care about what the banks say I do. I don't trust banks. I don't trust politicians. To me, police and thieves are natural brethren. I'm not throwing mud at anybody. As a mercenary, we have to survive financial combat every day so that our trading account prospers, our benefactors prosper. We survive, we eat. That's how we put food on the table. You got to grind it out. But understand this. The supply shocks from the ME situation, the supply shocks from certain geological situations, the supply shocks from weather situations happening right now have given us a lot of alpha producing situations that we're taking advantage of every day in the Crypto Public Desk Monthly. What a time to be alive. But you got to make sure you understand why you're in this, because we're going to be going sideways. And the way that you have to understand the market right now, as far as I'm concerned, not financial advice, just my own opinion and everything has capacities. You got to be like the goldfish. Goldfish swims to one side of the tank, forgets what the other side looks like. Why I'm saying this is that forget the daily chaos. See where we're going. That's all I can say. The daily chaos is designed for scalping. That's leverage trading. Position accumulating is the name of the game right now because the chaos is causing unbelievable entry points for certain things. I hope everyone's having a blessed day. I love you all. I'm going to see you on the front lines. Never invest capital based on watching a YouTube video. This content for education, entertainment purposes only. It's not for financial advice. Consult a licensed financial advisor. Never invest money based on watching a YouTube video. I love you all, ladies and gentlemen. I'll see you on the front line.